Who decides interest rates and how does it affect beginners? In recent news, many are curious about who decides interest rates and how this impacts those new to managing their finances. Interest rates play a vital role in the economy, influencing everything from loans to savings accounts. Just yesterday, the Federal Reserve announced its latest decision on interest rates, which has sparked conversations among young people learning about money management. Interest rates are primarily determined by central banks, such as the Federal Reserve in the United States. The Federal Reserve has a committee known as the Federal Open Market Committee, which meets regularly to set the federal funds rate. This rate is what banks charge each other for overnight loans. The committee considers various factors, including inflation and employment rates, before making a decision. In addition to the federal funds rate, each regional Federal Reserve Bank establishes its own discount rate. This is the rate banks pay to borrow money directly from the Federal Reserve. The discount rate is typically higher than the federal funds rate and is used as a last resort for banks that cannot secure loans from other banks. When the Federal Reserve changes interest rates, it directly affects borrowing costs. If interest rates increase, loans and credit cards become more expensive. Conversely, if rates decrease, borrowing becomes cheaper. This shift can influence how much individuals choose to spend or save. For beginners, understanding interest rates is essential. If you are considering taking out a loan for a car or a home, or if you have a credit card, the interest rate will determine how much you will repay over time. When rates are low, it can be a good opportunity to borrow. On the other hand, when rates are high, it might be smarter to focus on saving. During significant events, such as the COVID-19 pandemic, the Federal Reserve reduced interest rates to make borrowing more accessible. This was part of an effort to stimulate the economy and assist individuals and businesses in recovering. In summary, central banks like the Federal Reserve are responsible for deciding interest rates. Their decisions impact borrowing costs and can significantly influence how individuals manage their finances. For those just starting out, grasping the concept of interest rates is key to making informed choices about saving and borrowing.